Well, many people are saying that dividends are dying. The AFR says that they've slowed to a trickle, that they've gone. But I'm here today to tell you that dividends are still well and truly alive. I say long live dividends. In this uncertain world, there's only one thing I think that is pretty certain, and that is that actually what has slowed to a trickle has been cash rates. Cash rates are now as near as damn it zero, and we expect, and the market expects, that cash rates will stay around 25 basis points to zero for the next 2 to 3 years. I mean, even before COVID hit, the RBA governor was saying that we'd expect interest rates to stay low for a considerable period of time. Now, it's even lower for longer. That is a certainty, I think. But those low cash rates have dragged down similar assets. So you see that term deposits, and on this slide, the cash rates are the grey bar right at the bottom there, hedging into zero. The red line is term deposits, a series we get from the RBA, and they're now sub 1%, a one-year term deposit. And even if you start taking some credit risk, the RBA has a series which looks at BBB rated 3-year investment grade bonds. And the yield on those has actually now fallen below 2%. At end of July, I think it was 1.7%, which is not a lot of extra return for taking on that investment grade credit risk. But other more risky assets have also fallen. Clearly rents are falling, as we see shopkeepers are doing it tough, so are domestic residential renters. But also dividends have fallen. And we were out there quite early saying we expected the market to cut dividends by 30%, and dividends have come down. But in a relative sense, they still look pretty attractive. I mean, you can see from this slide, the blue line there is the gross yield on the Australian equity market, just the ASX 200. And the dark blue line at the top is the historical 12-month rolling yield on the Plato Australian Shares Income Fund, which just dipped below 8% at the end of July. So it's still a pretty attractive yield. Indeed, some might say it's even relatively more attractive. On this slide, we actually divide the yield from either the market in light blue again or the Plato Australian Shares Income Fund by the one-year term deposit rate at the latest available. And when we launched our fund about 8 or 9 years ago, we were generating about twice as much income as a one-year term deposit. We're now generating about 8 times what a term deposit is yielding, largely because the term deposit rates have gone down so rapidly in the last couple of years. You can see that large increase there. So in a relative sense, we think equity income is still very good, despite the sort of 30% cut in dividends across the market. But I think some investors, income investors, clearly probably don't share our views, because if you look at the traditional income stocks, such as the big four banks and Telstra, they have really struggled over the last 3 or 4 years. It's surprising, we've been running this chart for 3 years now, and it just keeps on keeping on, in that Telstra and the banks have continued to underperform the market in price terms, so they're actually underperforming in total return terms. They've also now all cut their dividends. I mean, Telstra cut early and cut its dividends by almost 50%, so that's one reason why it's struggled in the last 3 or 4 years. But the banks have been somewhat late to the party, as we've seen the impact of the Royal Commission, but more recently the bad debts due to COVID. So it's been a real struggle for those investors, because not only are they seeing their dividends cut, but they're also seeing their returns significantly underperforming the market. Now, we're very happy, as Ramsden has said, that our fund has not only delivered strong income, but we've actually been able to outperform the market over this tough time for traditional income stocks. To tell you how bad it's been, actually, we've got a pie chart there, and when we started this slide, Telstra was in the top 6. If you look closely, you'll find that Telstra is no longer in the top 6 dividend payers in the market because it's cut its dividend so much. And if we look deeper into what's happened in the market over the last 3 or 4 years, you can see a significant decline in the level of income, or proportion of income that's delivered by the finance sector, read banks, and by the telcos, Telstra. At the same time, though, the market is self-correcting. You've seen that there's been a big increase in the actual dividends delivered by the metal stocks, and in particular that's Rio BHP and the pure play iron ore miner Fortescue. They've more than doubled their income over the last 3 years. And whilst it's still an incredibly small base, there's some little gold stocks that have significantly increased their dividends. In fact, Gold's proportion of the market's income has almost tripled over the last 3 or 4 years. So some small diamonds there in that gold sector. Moving to the banks, or back to the banks really though, we see them to be a bit of a struggle for a number of years. I mean, they're now got the impact of reduced earnings due to COVID and the bad debts that are coming from that. And at the same time, APRA has come out and basically told them you can pay out no more than 50% of your earnings in dividends. So if your earnings are depressed and your payout ratio is lower, then your dividend's going to be much lower. So we saw even what we would say arguably the best of a bad bunch in Commonwealth Bank cut its final dividend by more than 50%. And regional player Bendigo and Adelaide Bank actually declined to pay a final dividend, so it omitted it completely. And Westpac similarly cancelled its already deferred interim dividend. So there's a lot less income coming from the banks. But luckily, those iron ore miners are actually taking their place. In fact, arguably, we're talking about the iron ore miners becoming the new banks or the new cash cows of the Australian market, and particularly the pure play stock Fortescue. I mean, Fortescue tripled its ordinary final dividend in the recent reporting season. So it went from 24 cents to $1. And is actually trading on a 14% gross yield. Now, normally we would think that a stock on a 14% gross yield is a dividend trap, but the reality is Fortescue's earnings are up 60%, its share price is up 60%, and it's still trading on a 14% gross yield. And BHP and Rio, they've got other areas that are holding them back, particularly BHP with some of its oil and gas assets, but they've still got traditional bank-like yields of sort of 7-8%, which is not too shabby in this market. So thankfully the iron ore miners are doing some of the heavy income lifting. But it's not just the miners. If we look at the retailers, whilst a lot of retailers are struggling, particularly the little clothes shops and those sorts of things, some retailers are doing really, really well. There may not be a sausage sizzle at Wesfarmers anymore or down at Bunnings, but their sales are certainly sizzling. So too is Officeworks. Wesfarmers owns both Bunnings and Officeworks, and their sales is going through the roof. As is JB Hi-Fi. We're all sort of resetting the home office, buying new computer screens, and you name it. And their sales are really going well. And JB Hi-Fi almost doubled its final dividend. So there are some pretty good income players out there. And of course, we all know about the sales at Coles and Woolies have been very strong. So the retailers are doing well, but not all stocks are doing well. We go on about the key to income investing is picking the right stocks that pay good dividends. It's also avoiding what we call the dividend traps. And I suppose the bad news on this front, if we have a model that aggregates the sort of, or looks at each individual stock, and then we aggregate this model across the market. And what we do in this model, we try and predict the likelihood that a stock will cut its dividend. And what this line or this chart does here is actually highlight that the likelihood of dividend cuts spiked very quickly in March, April this year to a level that was actually higher that exceeded the GFC. So that things were pretty bad, which is why we came out very quickly and said we expect the market to cut dividends by at least 30%. The good news about this model is, if you actually look at the right hand of this slide, you can see that the probability has come back fairly sharply. It is still at elevated levels. It is still a lot more than normal, but it is getting better, which is the good news, as we find that the impacts of COVID are probably not as bad as we may have initially thought. But there are still plenty of dividend traps out there. Here are just a few. Remember, a dividend trap is something that, I suppose the simplest way of saying it is, it's trading on a great historic yield, or it used to, and then it comes along and says, gee, things are pretty bad, let's cut our dividend. And maybe they cut it completely to zero. We've got 3 stocks here that have done that. So Crown, obviously the casinos are closed, under a lot of trouble. At the end of March, you could have bought Crown on a gross yield of close to 9%, but then it paid no dividend, so you get no income. Similarly, we've already talked about Bendigo and Adelaide Bank. They, excuse me, failed to pay a final dividend, so they were trading on a 15% gross yield. And that's got to be a bit of a giveaway if they're trading on a 15% yield because the share price has fallen away due to COVID. The market's telling you that there's something wrong with that stock, and indeed it failed to pay a final dividend. And similarly, Centra, clearly retail landlords are struggling and they failed to pay a final distribution. So there's plenty of dividend traps to avoid. out there, which is why you've got to be on your toes if you're an income investor. Indeed, the problem with COVID is that its impact is not evenly distributed. We call it the good, the bad and the ugly. Here are the top 20 dividend payers from last year. So they're not the top 20 stocks, but the top 20 dividend payers. And basically there are some stocks, like we've mentioned Rio, BHP, Fortescue, doing pretty well. Wesfarmers, CSL, not a high yielding stock, but its dividends are well supported, its sales are very strong. And Woolworths is in the top 20, Coles misses out. Those stocks are doing very well. Commonwealth Bank say the best of a bad bunch in the banks, and Westpac's probably the laggard, having not paid a dividend at all. So, it is a real mixed impact of COVID, and investors need to be very alert, very dynamic, and they need to be very active, because if you're still in those banks, you're going to struggle for income. Now, we've got Telstra there in the good stocks, which might be a little controversial because it has cut its dividends 50%, but that was about 3 years ago. It actually maintained its dividend in the latest reporting season, so that's why it's in the good. It's relatively good, but it's already had those big cuts in dividends. So finally, in summary, we don't think the dividend picture is as ugly as many people are painting. We don't think dividends have slowed to a trickle. What we can be fairly certain about is that interest rates are going to stay low for longer, or even lower for longer. I think cash rate's going to be around zero for the next 2 to 3 years for sure. And on that basis, equity income still looks pretty good, particularly if you adopt an active approach and go to where the dividends are, because there are plenty of good dividends out there. Yes, we stick with our 30% plus sort of cut for dividends at the market level, but you look to your Fortescues and your Wesfarmers that are increasing dividends, and your JB Hi-Fis, and there are still plenty of good dividends out there, which is why we still expect to generate around 7% gross yield this financial year, which we think stacks up pretty well relative to the income levels on other asset classes. And finally, I think given the uneven nature of the impact of COVID, I think it's very important to follow a very active approach and look at your portfolio closely, because there are plenty of dividend traps out there. There are plenty of stocks that used to pay great dividends and may not be paying dividends at all for 3 or 4 years. So it is very much a stock picker's market, and avoiding those dividend traps is more important, I think, than ever. Thank you for listening.